Good afternoon, Alan. This is the last Friday of February. We're going to do our Friday investment talk. Just you and me again this week until Veronica gets back. Lots of things happened in the market this week. A lot of those things we were expecting. So let's go over some of the big events.
Yeah, I think there's just a lot to discuss because the market has been, just all over the place, really. Lots of front page news almost. So, Market's going down.
Let's look at some of the headlines. Some of the things that were on the docket this week for the economic indicators or economic results for the week kind of brought some headlines. And one of the main things that set the market off this week was the mortgage applications rates. So mortgage applications means people applying for new mortgages in the United States. And this is basically the foundation of the housing market. So we saw that number come in real low at a negative 11% when the previous was at negative 5%. Mortgage rates went up from 2.98 to 3.08. And this is the thing that scared the market. Again, interest rates are going up. Money is harder to borrow, and it makes investors
less
a little bit nervous.
Less demand for mortgages, less demand for houses.
Yeah, and that's where a lot of people's wealth is. So you start,
right.
You start putting interest rates up. It has an effect on people. We mentioned last week that PPIs were up, price indexes were up, and people again seeing inflation there. That had an effect on the bonds that we discussed last week. That had an effect on interest rates on those bonds and affect the price on TLT. The last thing we want to look at is personal income in the United States increased 10%. And that's probably because of a lot of these stimulus checks. There's a lot of money out there, but the fact is free money is coming to an end as interest rates go up. And we discussed a lot of that last week. And so those were the headlines that kind of spooked investors. I want to bring up, ARK. We want to talk about the ARK fund and how just in terms of how that, because that's a real retail type of investment that a lot of people watch. And
this is where you're bringing it up. This is basically a proxy for the growth economy, for innovation, for genomics, robotics, Internet of Things, you name it, all of those things. It's got a lot of press. It's grown hugely, both in terms of returns and in actual size. It's huge. It's about 50 billion, or it was about 50 billion in size, compared to, I think, 2 years ago, I think it was 3 billion. So it's just a huge amount of money going in there. A lot of, some of that reversed this week. I think there's a graph that you maybe will bring up, but another 500 million outflows yesterday. That's Thursday. And earlier in the week was another 500 days. So we have some liquidity issues because of that, because the amount of money that's getting taken out by ARK from ARK ETFs. And I was actually talking about Scottish Mortgage Trust, which is kind of a similar one. It's the second biggest institutional investor in Tesla. It's the biggest UK unit trust, something like 13-14 billion pounds. And that's had very similar drawdown, very similar outflows of cash on the scale.
Well, let's look at Tesla real quick, Alan.
This is 20% down. Actually, it's still up, I think, year to date, but it's down 20%. And Bitcoin is down 25% year to date. These were the bubble stocks that we were talking about in January. Mm-hmm. And we were telling investors that, look, middle of February to the third week of February is going to start to get very weak, get a bit choppy, time to take some profits. This is basically expected, actually, and it's very healthy. It's good to have this pullback. If you're being nasty, you could say it would be good to have a little bit more of a pullback because we're ready to get back in. It's easy to pick a bottom, it's difficult to pick a top. And we're maybe not at that point yet, but we were also looking at other areas that we could get into. We looked at commodities last week. What was interesting for me this week is that gold is down from a 1 year level. And we were just talking, Chris, that if you're thinking, it goes back to bond yields and goes back to inflation. Inflation is coming hard. If you think that's been reflected in bond yields increasing, then you should be seeing gold going up because people will start to get worried about inflation. You're not.
Right. technically gold broke an important level here, and I think that's really what happened too. To add on to the selling was, you can see this line I drew right here. It's just like these are previous tops and the previous bottom here, and it just went sliced right through that today. It's down 2.5% today, and the reality is we've had no interest in gold for since up here when we thought it might break out. And really the idea here is that if there is inflation, it's not going to be incredibly hyperinflation or a drastic inflation, and so it'll be manageable. Plus, the Fed can manage it in many, many ways, and there's really no risk of deflation when we expect between 4% and 6%. And I think GDP came out last week and was at 2%, and we expect that to be growing substantially as we get back to a normal state after the pandemic. So there's really no reason, and there hasn't been any reason, to hold gold. That's not a commodity that's working, and we discussed that I think last week a little bit, Alan, when we talked about inflationary commodities like oil and like we can bring up crude, but these are the types of things you want to be in, and those are reacting since the beginning of the year really well. Since the beginning of February, particularly, oil's up 18%, which corresponds basically to this fall in TLT that we recognized and talked about last week. So you see, what we're going to see for a bottom, and what we're going to look for a bottom is for this TLT to stop falling, and that's happening today. The TLT is actually up today. There's some recognition that, look, interest rates are at 1.5% on the 10-year, and they were up overnight or yesterday at over 1.6%. We did a webinar on Wednesday, and we had a question that, when do you think we're going to see 1.7% interest rates? Will we see them this summer? And I said, you're likely to see them in 2 days, the way this thing's going. So the market got into this parabolic fear of higher inflation, and that led to a really quick move in interest rates. But interest rates aren't stocks. They're not an asset like that. It's based on inflation, and inflation, from a low level, it can increase quite rapidly, but it gets marginally more difficult to increase as inflation is higher. So are we scared of? And I think you made a great comment last week, Alan, when we looked at this, was, are we really scared of 2% inflation, or are we really scared of 1.5% interest rates? Are we really scared of these things that are just kind of would be a normal economy without the pandemic? Actually, a struggling economy without the pandemic, and we would have these low interest rates and these low levels of inflation. And the answer should be, the market should be excited about this. If the GDP can grow next year 6% and you have inflation rates around 2%, you're fine. I mean, that's 4% real growth.
That would explain the lack of gold being in a client's appetite.
Exactly. That's the perfect Goldilocks economy. So this is just a reaction to the fact that we're actually seeing some inflation, maybe, but that doesn't mean it can actually continue to grow to where we get like 3-4% inflation rates. And even 3 and 4% inflation rates, the Fed would have to do something maybe, but we're nowhere near that yet. And the Fed actually wants inflation. So this weakness we see in the end of February is traditional. We brought that up before on our blog. It's a reaction to pumped up markets since November, and we really have to watch for where we go from here. So ARK is an interesting.
I think you brought up there was an article that we discussed. I think it's from Market Watch, and one of the things that it had brought up was why this had happened: bond yields movement, inflation movement, and one of the criticisms almost was that the Fed hasn't done anything. Like, well, the Fed doesn't want to do anything right now. It's going the way it wants to go. That's the whole idea.
Right.
Of trying to reflate the economy.
Right. And Jerome
that.
Powell actually came out with that on Wednesday and said, look, there's nothing for us to do. We're going to continue to buy bonds. We're going to continue to keep the stimulus until we get out of this pandemic. There's no change in that. And so maybe that, that one day kind of reassurance from Powell sent the market up, and it was a good rebound. But the fact of the market is in a downtrend right now. IBD changed it, I think, yesterday to an uptrend under pressure. We have to watch in this seasonally weak period, end of February, which is today, and then end of March, which is in 2 weeks' time or so. So we have to really be careful that, we might get a little bit of a bounce as TNX comes down a little bit and TLT kind of stabilizes here.
Today. Dollar is
right, and TLT strengthens a little bit today. But the reality is that we're in a choppy period, and we have to forget how the market was for the last 3 months, because the market's not like that anymore. The market is reacting to new news of a reopening economy, and these tech stocks are overvalued on any kind of fundamental perspective. You can't take a company and sell for 33 times earnings like Apple or Microsoft, even if they grow, tremendous revenue and tremendous growth. It's all priced in. It's really all priced in. So where can we find value?
We were looking at defense stocks, I think.
Right, defense stocks. And one of these things, and really, I'll tell you, the market is in a period here that you do not want to be buying stocks, because when you get a clear breakout on a value stock that will benefit tremendously from the market, the economy opening, and then it pulls back and it creates a false breakout on that is not a time to get super excited about being in the market. But these types of stocks like Raytheon, and then we had Honeywell, we had these other stocks that look like, they got bullish when Powell spoke, have come right back down into their ranges, and places that maybe in the future, if the market is repricing opening and re-gauging how the economy will be after the pandemic, these are likely the places that will benefit. These are large companies, big holdings, and
stable companies that pay dividends and turn a profit.
Right, and so even our little friend AT&T, was doing well until recently, and this is a stock you want to watch here, because if the market is going to start opening, you can get a nice gain in this stock in just a few days, actually. Well, this is a 7% income that pays on this. Okay, Lockheed Martin, is another one where it looked like it was going to turn up here, and it's turned right back down. Let's talk about one stock we do like, continually have liked, and really think there's a great opportunity long-term for this, is this DKNG. And this is DraftKings. If cannabis is a story of liberalization or deregulation in the United States,
narcotics,
in drugs, right? This is
one of the other 7 deadly sins.
Exactly, this is the equivalent in betting, and this, if economies open, sports events happen. Right?
Especially
this is
college,
where it's going to be. College sports event. This is where it's going to be. This company came out. I'm just going to review real quickly what it came up with this morning for results. Revenues guidance of 900 to 1 billion versus the prior guidance of 750 to 850 versus a fact set of 172 estimate. So they're increasing their guidance. And their quarter four revenues were 322 million versus 233 million. So almost 100 million more. That's 30%.
A huge percentage.
Yeah,
50%.
Right. And they were growing at 98%, almost 100% year over year. So they're raising their guidance for fiscal year 21 to have revenue of probably around $1 billion. Those are low estimates to me. I'll tell you right now, I think these are low estimates. When you're growing at 100% and there's no games, there's really no games, you could see triple revenues next year. And states are just beginning to open up to this. So this is a huge potential. The stock hasn't sold off really in this last little bit, except for that one crazy day here. But I think there's a real long-term reason to be in this stock. And And technically this is a kind of long-term cup here with a little handle right now. So if this breaks above to new highs, this is definitely a buy again.
I had a question. VLDR, Chris.
Yeah, these are
This
some
used
of
to
the
be a favorite of ours, and then I think we kind of sold out of it.
Yeah.
Is it a good time to get back in? Maybe?
I actually still own this stock, this and a couple other junk.
Sorry about that.
Yeah. But yeah, this is the electrical vehicle stuff, and this is the problem. I mean, the electrical vehicles got really hit hard. Tesla was the kind of the leader. These are the overpriced stocks. XL Fleet was another one that was hit pretty hard. Yeah. But with Tesla unable to find any footing, and likely not to find footing until it gets to around $600 a share, and even then, you know, there's no sense in owning a stock that is, what is it? Current PE on Tesla is, what is it, 1,281, and the price to cash flow is 132. I don't know what people are thinking. This is at least 10 times overvalued by any normal metric. So you got a market cap on this company of $651 billion. So I don't know if you know there's any value in Tesla. The fact that it's the only real producer of cars right now, but that can change rather quickly when new entries come to the market. So we have to watch what's going to happen here. I know a lot of people, this is a cult. You can't say anything bad against Elon Musk, Uncle Elon, they call him on Reddit. And you can't say anything bad against Kathy Woods. She's on Kathy. So these are the people that get the retail investors really pumped up. And this is just kind of falling out now with the retail investors. Where it will land, I don't know. But, you know, there's some spots here where you can see some strength come, you know, some bottoming come in. So, but these are numbers, you know, where the stock would be maybe another, I don't know, at least 10% down, and maybe at least all the way to 50% down. I don't know. So VLDR, these stocks are interesting because they have the technologies that other companies can use. There's a lot of stuff that's going to be developed. A lot of the semiconductors we talked about, STM. There's all kinds of ACMR.
Yeah, we'll maybe cover semiconductors next week. We just have too many things to talk about this week.
Right, and I think we covered them last week a little bit. The issue really becomes we need to see a normal market again, and we're not in that right now. We have to forget that. You can't just say, okay, it's down now, so I'm going to buy it. No, this is not a buy the dip moment. This is not a dip anymore. This is a big time pullback of 25% in this stock. You know, Tesla's down 18%. So we have to wait for these things to bottom. And I just wanted to get some ideas about when things might bottom. Things might bottom again, like I said, when we see a reduction in the fear over inflation. But for these stocks, a lot of the stocks have to come down between 30 and 35% would be a normal bottom, and they can come down as far as 50 to 60% before we see a bottom. So do we go out and short these things? No, because you know, Jerome Powell and the Fed is going to act as a put to this market. They're going to stop anybody from a loss of real value here. So we don't know when that's going to happen, but you can't just say, okay, let's go out and get crazy here, shorting everything. We could have been shorting or getting less aggressive for sure, and maybe a bit more aggressive on the downside back in mid-February when we were talking about that, but not now. So this is going to be, in our perspective, and I can bring up the March seasonality maybe to wrap this up a bit, Alan. Volatility is going to come back and that means both up and down markets in March. So the first part of March is actually quite bullish. The first day is good. The third day is good of trading. So we can see that there's some bullishness in the first part of March, and that's probably, you know, seasonality is probably going to hold this year because we did have a good pullback in the end of February. So with that being said, later on in March, and especially on some of these later on in the weeks, and some of these weeks, you can really, you know, 3 weeks into this, you got to watch out that we don't get carried over into, oh, we're back into this bullish market. We can all be buying stuff again, because the end of March is really bad. So if you're going to play anything, it's a short-term play on a bounce here through the first 2 weeks of March, and then get ready for some more fireworks later on. later on. It's okay to be in cash. I want to just add that, but it's actually good to be in cash. It's good to sit on your hands for a little while and just watch what's going on, because the easy money is not in the market right now. The easy money is just we made good money in the easy money period from November till mid-February, and now we have to wait and see. I mean, the real easy money doesn't happen again until July, Alan. That's really, that's really, you're going to get a big bullish month in July, but from now until then, it can be back and forth and back and forth. So that's really what
I think next week we also got to look forward to our relative value. It's the first of the month, so we'll review that next week. So that'll be something to look forward to. Assuming everything else is quiet, which I very much doubt right now, but you never know.
I think emerging markets are going to be an interesting place to look. If things stabilize and inflation does come back, some of these emerging markets didn't break down as much. They have some real value here in terms of commodities. So places like EWZ might be an interesting buy here. It's already down quite a bit from its peak. So okay, so we'll see you next week then.
Yeah.
Have a good weekend. Take care.